spell out clearly, because the emphasis is now on reforms and making India a Viksit Bharat 2047 mission, because a lot of schemes have been introduced which will also encourage job employment, etc. Without wasting much time, because we are already there at sharp 5 o'clock, we would like to hand over back to zone chairman for further proceedings, and congratulations to him for continuing the legacy of Central Zone on organizing the budget talk on the same day. Over to you, Lakshman.
Thank you, sir. Now I request our Secretary General Sri Bhaskar sir to kindly address the gathering and share a few words with us.
This is one budget where vast changes have been made both to the old Income Tax Act as well as to the new Income Tax Act. I am also eagerly waiting for the Speaker to spell out clearly what are all the amendments that had been made. Thank you, Lakshman. Continue.
Thank you, sir. Now I would request now our Deputy President Sri Sanjay Kumar ji to say a few words with us. Sanjay Kumar ji.
I think he's out.
He's out of range. So
Thank you. I now hand over the proceeding to our session chairman, ADV Pankaj Ghiya ji, past president AIFTP, to kindly address the gathering and take over the further proceeding of the sessions.
Friends, I welcome you on behalf of AIFTP. And I would simply say that the budget talk on the same day is a taxing provision on the speakers, because they have to listen to the fact, the budget speech, the finance, see the finance bill and prepare for the evening. And even the question answers would be there. But the curiosity is always there. And the list of participants shows that we are gaining participants each and every moment. And they are very eager to hear the speakers. We have two fantastic speakers in GS Prashant from Bengaluru, who is a wonderful speaker on income tax, direct taxes, and could explain very well. And we see him out and out daily on the various TV shows. We have the second speaker on GST and allied laws in Dr. Arpit Haldia. Again, a very young, prolific speaker, a book writer, a paper writer of par excellence, and a dear friend. And we would say that these two are the new generation assets for AIFTP and for the tax profession. I wish them both. I don't want to come in between. But as a lawyer, I would simply say in all the budget provisions, the Jaufau controversy with the retrospective amendment, it is something that you fight in the courts day in, day out. You win in the court. You win the battle against the lapses of the government. And then the government comes and by one stroke of amendment, that is a retrospective amendment, just cure it and say it is retrospectively, we correct our mistake. So ultimately, going to the courts, going to the High Court, going to the Supreme Court, it is all a futility, because ultimately, if the government is wrong, they can always correct it by a retrospective amendment. We will be challenging the retrospectivity of the amendment, but how long litigation again it will curtail? There are more than 2,000, 5,000 pending litigations before the Supreme Court already. We will have to see. With this caution about the retrospectivity of the legislation, I would simply hand over the mic to Mr. Prashant for taking the course further in the direct tax. And after the session of Mr. Prashant, we will be hearing the session of Dr. Arpit Haldia. Hand over to Prashant.
Thank you, sir. Thank you, AIFTP Central Zone, for having me here. We are indebted to our parents for life. We are indebted to our Guru for the way we live. I take this opportunity to place on record my deep sense of respect and gratitude to my mentor, CA S. Venkatramani, who has been a guiding force and factor in my endeavor of profession. Also, my respects to CAD Devraj and CA Shankar, who mentored me at various stages of my professional career. To say beside and set the tone down, when the finance minister presented the budget today, the expectations were from all sections of the society, multifold expectations, I would say, in terms of what's the roadmap and what are the changes, how investor friendly it's going to be, so on and so forth. So therefore, to give a brief of as to what happened during the run up to the budget also is very important in terms of the reforms carried out. If you look at what happened in 2025, the income tax limit was enhanced to 12 lakhs. And then you had the GST relief kicking in from October 2025, that is during the Dasara Diwali season itself. So which means reform has been used as a, not as a budget tool, but more as a ongoing process to say how the amendments have been carried out or how a relief oriented the government is. And if you especially look at the usage of the terms when the FM started the speech, it spoke about the government's sankalp to support the poor, underprivileged, and disadvantaged. And they also spoke about their duty, which means she spoke about the three kartavya, saying that to accelerate economic growth, to fulfill the aspirations, and to ensure that every family, community, and region has access to opportunities. And she also focused about 6 areas about manufacturing, rejuvenating legacy industrial sectors, championing the cause of MSMEs. Infrastructure push has been given in a great way, wherein the public capex has been increased to 12.2 crores from the earlier 11.1 lakh crores. And then you have the long-term energy security and stability, wherein they're wanting to have the carbon capture, utilization, and storages. And about 20,000 crore has been planned to be invested in the next 5 years for that. And you also have the city economic regions and high-speed rail corridors. And they are developing 7 regions. That is Mumbai, Pune, very much needed. Pune, Hyderabad, Hyderabad, Bangalore, Hyderabad, Chennai, Chennai, Bangalore, Delhi, Varanasi, and Varanasi, Siliguri. Which means across the spectrum, you have connectivity in the west. You have it from the west to south, within south, and you also have in the north and from north to northeast also. So therefore, it's a very ambitious budget in line with the objective of the government being Viksit Bharat 2047. And when the goal is set as Viksit Bharat 2047, what we come across and how the reforms have taken place in terms of the sustained economic growth and fiscal consolidation, and what is the roadmap for Viksit Bharat 2047, and truly by decriminalizing a lot of small small minor offenses, unlocking the power of the MSMEs, and you have vast schemes being brought out for the long-term infrastructure growth, especially on the coastal side also, wherein for cargo promotion scheme they have brought in, and the ship ecosystem, a ship repair ecosystem is being planned at Varanasi and Patna. So again, the north and the eastern regions are being benefited there. They also have a scheme to have last mile connectivity for tourism, especially to have this seaplanes and the seaplane VGF scheme. So all this in effect will boost the tourism sector, and more so in line with how the government has carried out its ambition of Viksit Bharat, and in terms with how you're blending religion and culture with prosperity. So therefore, looking at that, even the temple towns have been given that support, wherein they want to unlock the potential of the temple towns in terms of tourism. So that is how the government is functioning, and definitely looking at how the rural India has been given the benefit. the budget is proposing the Mahatma Gandhi Gram Swaraj initiative to strengthen khadi, handloom, and handicrafts through global market linkage and branding. So, therefore, this one district, one product initiative which we had also contributes to this particular initiative of the government. Now, time and again, we have heard that the eastern India and the northeastern states have been neglected and nothing much has happened. But the government's mission towards Mission Purvodaya, which was launched in 2024-25, is already a transformation tool for Bihar, Jharkhand, West Bengal, Odisha, and probably to some extent in Andhra Pradesh also, wherein you have an integrated East Coast industrial corridor with a node at Durgapur and tourism destinations across those Purvodaya states. And you have about 4,000 e-buses, national waterways in Orissa, and a National Institute for Food Technology in Bihar, National Institute of Design for the Eastern region. As I said earlier, ship repair ecosystem in Varanasi and Patna, and the National Mental Health Institute. You had one in the Bangalore, Nimhans. Now they're having one more to be set up in Ranchi. And also so that the National Mental Health Institute in Ranchi will be upgraded as a regional apex institute. And also the freight corridor connecting Dankuni to Surat and rare earth corridors in Orissa. So this means across the nation, the emphasis has been on development and to ensure that manufacturing is given its due, and there have been no specific SOPs being given for any poll-borne states. All regions have been equally looked after in this particular budget. And even if you look at the welfare of the farmers or the annadatas, whom we call, a coconut promotion scheme has been brought in, a dedicated program for Indian cashew and cocoa is being brought in, to ensure that India will become self-reliant and transform into a premium global branch by 2030. Now, we have how you're looking at Amrit Kal, because in 2022, we visualized that the next 25 years, in line to become Viksit Bharat from 2022 to 2047, is being touted as the Amrit Kal. And you have manifesting the Amrit Kal through social justice and welfare across all the sections. We've seen how the 82 crore people have been benefited through rations who really deserve that. They did not have enough financial needs there. And you also have about 24.8 crore people being lifted out of multidimensional poverty in the previous years to ensure that the standard of living of those people also goes up. Now, in line with that, you're having targeted support for weavers and artisans. It is being proposed that you'll have a national handloom and handicraft program to integrate and strengthen the existing schemes, because various states will have different schemes, but you'll have a national body to ensure that the handloom and handicraft sector is taken care of. Now, coming back into the main focus for the day being the taxation reforms and how certain amendments have been carried out. Pankaj already spoke about a couple of them. There were two or three controversies which were ongoing. One is the jurisdictional assessing officer and the faceless officer. In fact, last week we had a special bench sitting in Bangalore also, in Bangalore Tribunal, on the same aspect, saying who is the relevant authority for issuance of a notice. And what has happened now is the amendment has happened in 1961 Act also by bringing in a section 147A to say that the reference for issuance of a notice was always deemed that it shall be for the jurisdictional assessing officer. So the controversy saying a notice is being issued by a jurisdictional officer, but the assessment was getting conducted in the faceless regime, now stands in favor of the department by virtue of this retrospective amendment, because they've brought in that amendment with effect from 1st April 2021. That's when this news came after the TOLA took charge. And you also had the other issues about the time limits under for DRP proceedings or the draft order and the time limit for completion of those proceedings. So, what happened was matter reached up to the Madras High Court in Roka bathroom case, and it was in favor of the taxpayer to say that what is the timeline for passing the draft order and consequently the final order, and whether the time limit specified in 153 would overrule the specific time limits given in 144C, because 153 time limits were always for the overall completion of the assessment, and whereas specifically you had 144C operating for DRP proceedings. The controversy went up to the High Court, and how the court looked into the matter, and the matter subsequently went to the Supreme Court as well. And you had a split verdict being rendered on what is the power in terms of 144C, and whether it subsumes into whether the time limit under 153 will prevail or for the final assessment, or should you reckon the time limit for the draft order. And the moment you had a split verdict in the Supreme Court, wherein the division bench of two judges rendered separate judgments, it went back into a position wherein the Chief Justice had to constitute a larger bench to look into the issue, and that was what was mentioned at that point in time, that a larger bench would be constituted. In the split verdict, one of the verdicts was that it was in favor of the taxpayer, contending that once you have 153 speaking about a particular timeline, and that timeline had to be adhered to, and that can't be extended in any circumstance. And you had the dissenting judgment, or so-called the judgment favoring the revenue, to say that it is only for the draft assessment order and not for the final assessment order. So now that particular thing has been amended with retrospective effect from 1/4/2009 in the Income Tax Act 1961, to bringing up an amendment saying that notwithstanding anything contained in any judgment, decree or order of the court, they've clarified, it is proposed to clarify in section 153 and 153B that this timelines in these sections govern the draft order stage, and the timelines in 144C operate for finalization of assessments, notwithstanding the time limit in 153 and 153B. See, this leads to an interesting situation wherein how the courts time and again have interpreted the law as it stood then, and then subsequently how the legislature has chosen to overrule that by specific amendments. You look at what happened in the 148 controversy in Ashish Agarwal's case, wherein officers had missed out on issuing notices and they had become time barred. So Supreme Court then used its powers under Article 142. And once Article 142 is invoked by the Supreme Court, and they have their powers are very wide in that. But just to give a context as to a couple of cases where they had used 142 article before Ashish Agarwal, they might have used in many others. Just to give a context, they had used their powers under Article 142 for the Bhopal gas tragedy case. They had used Article 142 for the coal block mining scam, and then Ashish Agarwal. You look at those things in like the principal agencies generis, Bhopal gas tragedy, coal block mining case, Ashish Agarwal. First two were of national importance, and then they stepped in. Whereas in Ashish Agarwal, they used their powers to pardon the department, saying many officers have made a mistake, therefore revenue is at stake, and they use the powers under Article 142. Be that as it may. Under Article 141, anyway, it is binding on everybody, specifically what they have brought under 142 also. Now that this controversy about the Roka issue, as it is fondly called, is laid to rest with this amendment with retrospective effect, because the government has clarified its intent. And yes, Pankaj Bhai spoke about challenging it on the validity of that. Yes, it will definitely be challenged, at least in some courts, but we have to wait and watch as to how the court should interpret the particular amendment. I'm sure the interpretation would generally side in view of holding a provision to be constitutional rather than otherwise. And you had one other legacy issue, I would call, wherein many tribunals had a lot of issues piled up on the DIN issue, wherein if the document did not contain a DIN, the powers were wide enough to say that the order was void ab initio. So they have brought about a clarification, I think, by bringing in a new section, I think, in terms of 292BA or something of the Act, to say that 292BA to clarify that, clarified to say that, again, it is proposed to clarify in 292 that notwithstanding anything contained in any judgment, order, or decree of court, no assessment in pursuance of any of the provisions of Income Tax Act shall be invalid or shall be deemed to have been invalid on the ground of any mistake, defect, or omission in respect of quoting a computer-generated DIN if such assessment order are referenced by such number in any manner. And this again goes back to the date that is retrospectively from 1st October 2019. So therefore, the three controversies which held a lot of us together, which all of us were benefited professionally in terms of fighting these cases now, it goes back to stage because in recently, insofar as the ROCA issue is concerned, certain tribunals had started passing orders, giving liberty to the department to prosecute the appeals later if the judgment is in favor of revenue. Now that the act is being proposed to be amended retrospectively, and it will definitely receive the presidential assent within before 31st March. I think we must be ready for notices on all those appeals which have been in favor of the taxpayer. And now from April 1 onwards, you'll have to fight it on merits, D-horse, you winning it on the legal issue. I mean, so far as the amendments that have been brought about for in Income Tax Act 1961 are concerned. What is the bill? They have spoken about decentralization and decriminalization of a lot of offences. There's a small amendment in 92CA of the time limit again. It was again to deal with the how you compute the timeline of 60 days in 92CA when the order had to be passed. There was this issue of how do you compute the 60 days in a leap year and a non-leap year. So therefore now they've again it's a retrospective amendment from 1st June 2007 to say that when the period of limitation expires on 31st March of any leap year, not being a leap year, the 92CA order shall be made up to 30th of Jan. And if it's a leap year, the time limit is 31st January. So that the 60-day time limit for the calculation of 60 days, now it's very clear by inserting 92CA 3AA with retrospective effect from 1st June 2007. So once this amendment has come through, you also have, as I spoke about, the reassessment amendment in terms of by introduction of 147A to speak about the insertion of with effect from 1/4 retrospectively from 1/4/2021 onwards. And then you have the time limits under 153, those which are consequential and clarificatory in nature to the amendments made to the DRP provisions. And definitely, government has definitely given emphasis to decriminalization of a lot of offences and rationalizing penalty and prosecutions. That has been the drive of the government for some time because a lot of outdated laws were repealed in the years running up to the budget. In fact, in the last 3 or 4 years, many of those hundreds of old laws were repealed. And now, continuing with those things in terms of penalty under section 2 under 220, wherein you will be charged interest for penalty. They have specifically stated that no interest shall be charged under section 220 till the date of passing of the order under 200, that is under till the CAT appeal order is passed, there shall be no penalty. For interest calculation will begin only after the CAT order is passed, where the appeal lies to the CAT directly. And where it is, the order has been passed in pursuance of directions to DRP, where the appeal lies to the tribunal, then up to the date of passing of the order under 254. So that's a relief being given in line with the objective of the government to say that you will rationalize the interest, penalty, and prosecution proceedings. And you also have the time limits increased both under the old regime, that is the Income Tax Act 1961, and the 2025 Act. You had the 9-month time limit for filing this revised return that has been extended to 12 months now. But they also brought in about a concept of fine being paid for the differential period. If the total income is less than 5 lakh, then the fine remains at 1,000 rupees, a sum of 5,000 if it is more than that. That is under 234I of the, by bringing in specifically 234I with effect from 1st March 2026. And in terms of penalty rationalization under 270A, they've also given the benefit saying, if any additional income tax is paid in terms of 140B, that is tax payment for updated returns, the income on which additional income tax is paid shall not form the basis for the imposition of penalty. So that you need not worry about penalty on higher sums paid and declared during the updated returns. It's only on the original income declared that the penalty would kick in. You also have the amendment of section 270AA, wherein when you're dealing with immunity from penalty, you had immunity if the penalty was levied for only underreporting of income. If it was misreporting on account of under 270A subsection 9, if your case was falling under 270A subsection 9, it was deemed to be misreporting and the penalty was 200%. There was no immunity for that. Now, under 270AA, they've substituted all the 3 subsections, and in subsection 1, they brought in a clause B to say that where penalty is levied or leviable under 270A subsection 9, wherein the penalty was 200%, if additional income tax of 100% is paid, then you will get the immunity. In effect, if you are falling under the underreporting, you will get direct immunity if no appeal is filed and you file the prescribed forms within the time limit specified. If your case is falling under the 200% penalty category, you get immunity by paying 100% of that, which means it's a saving of 50% insofar as penalty is concerned, subject to you satisfying other conditions. And under the penalty under 274, because all of us know that how the notices of penalty are 274 read with so-and-so section, it was always subject to principles of natural justice. The section always used the word saying that reasonable opportunity of being heard had to be provided to the assessee. Now they were specifically brought about to say reasonable opportunity of being heard to the assessee by way of by issuance of a show cause notice also to that effect, so that you'll also be given an opportunity to rebut or support your case in writing also. That has been specifically brought about in terms of 274 with effect from 1st March 2026. And one important facet is wherever you had the rigorous imprisonment provisions in Income Tax Act 1961 and the Income Tax Act 2025, this rigorous imprisonment has been tapered down to simple imprisonment only. And they've also brought in grading of the offences there, and they brought in monetary limits for between 10 and 50 lakhs, and exceeding 50 lakhs, what happens. So therefore, even under the new Income Tax Act 2025, what they've done in the old regime, you had maximum imprisonment for 7 years. That has been brought down to 2 years now. And in the old regime, you had for subsequent offences also it could run up to 7 years. Now, even for subsequent offences, the maximum imprisonment is only 3 years, and that too is only simple imprisonment and not rigorous imprisonment. And if the amount of tax evaded is less than 10 lakhs, it's no prosecution, but it's only with a fine now. This is in line with decriminalizing minor offences. So that it's in a way to look at it for ease of doing business and benefits to the small taxpayer. Even for prosecution proceedings, so 276 C, CC, 276 CCC, which is dealing with failure to furnish return of income in such cases, all of that they have been given the benefit that wherever you have the simple rigorous imprisonment, it has been now tapered down to simple imprisonment. And the last amendments, already I spoke about the issue about DIN. It is by virtue of insertion of a new section only, 292BA. Though it's clarificatory in nature, they have brought about a new section after 292B, that is 292BA, to say that if an order has been issued without DIN, you cannot say that it is invalid, despite having rules to the contrary. Now that it's specifically being brought about as part of the statute itself. Now, what are the other amendments which we have to look at it in terms of deductions related to employee welfare? You always had the controversy even under the 1961 Act in terms of 3615A, which now corresponds to Section 29 of the new Act 2025, wherein the terminology and the language used was the contribution collected had to be remitted as per the due date of the particular act. So therefore, there was no leverage even till the due date for filing the return of income. And you obviously had the checkmate services case and other things to say the time limit will not stand extended and other things. Now, under the new Act, Section 29 of the Income Tax Act 2025, they brought about an amendment to that to say in 263(1) of the Act corresponds to 139(1) to say that if the payment is made in line with the due date for filing the return of income under 263(1) of the Act, it will be allowed. And this is with effect from 1/4/2026, which means for assessment years beginning 27-28 or the tax year in the new regime, what it is called as. We have to overcome this. We have to come out of this previous year and assessment year now, because only till 31st March 2026, those terminologies can be used. From 1st April 2026, it is a financial year or the tax year that we have to use. So from tax year 26-27 onwards, the deduction under 29 would be allowed. One other important amendment which is brought about is you had the interest income for compensation received under the Motor Vehicles Act 1988. So that particular income now has been made exempt, because that is Section 11 of the Income Tax Act 2025 deals with exempt incomes, read with Schedule 3 to say that which is an income exempt. So for interest income received provided to an individual or his legal heir, or any income in the nature of interest in the Motor Vehicles Act is exempt from income tax. And consequent amendment is, because the income itself is not subjected to tax, you had a clause where TDS ought to have been done if it exceeded 50,000. Even that particular clause under 393(4) now no longer is required to be adhered to. And what is the benefit for the professionals? I would not say benefit, but in terms of relaxation of time. The people who are filing ITR 1 and 2, the due dates would remain at July 31. For individuals having business income and for charitable institutions and other things, you have the due date being extended to August 31. And they've also rationalized the timelines for the partners in a firm as to what is the due date for filing the returns. It's probably, it is giving that extra elbow space from July 31 to August 31 for non-salary cases, I would say. People who have business income who are not subjected to audit. Now you have to align with July 31, August 31, and then the regular tax audit due dates. And you have the extended time available for revising the returns. It has been given under the old regime also and under the new Act 2025 also. Up from December 31st, it has been brought about for 31st March. When you talk about updated return, the issue was the updated return could not have been filed if you had to reduce the loss. And there were a lot of representations being received for that. So, in terms of that, the amendment has been brought about to say that updated return can be filed to reduce the loss also. You also have a case where can updated return be filed after issuance of reassessment under 280 of the new Income Tax Act 2025. They have permitted filing of updated return after issuance of a notice under 280 also, but subject to the condition that 10% additional income tax has to be paid. So the concept is very clear. You will be allowed to file an updated return even after the issuance of a reassessment notice. That is the important facets that we have to now look into it. I'll just take you to the next amendments which have come about in terms of the corporate tax amendment. One of the important amendments which has come out is the MAT rate has been reduced from 15% to 14%. And from April 1, 2026 onwards, MAT will be treated as a final tax, meaning that companies can no longer accumulate new MAT credits. But however, you have this grandfathering provision applicable. Existing credits up to 31st March 2026 can be utilized. So therefore, this is a welcome move because you had situations where the MAT credit was getting extended or accumulated for many companies. Now that it is a final tax, it's more like no set-off will be permitted for them, but the rate also has been reduced from 15 to 14%. And in terms of relief in procedural aspects to the taxpayers, you had the lower deduction certificates. Under the old income tax in 1961, it was 197. Now it is section 395 in the new act. To get this lower deduction certificates, you can, it's at the option of the payee, you can make an application online and the officer shall allow your petition or grant it or reject it based on an online application also. So there's no requirement of manually making a application there. And you had one more, another difficulties being faced by the buyers of the property, especially in terms of deduction of tax at source when the seller was a non-resident Indian of a movable property. Even if you had joint owners, couple of them were residents, one was a non-resident, the requirement of law was that you are supposed to obtain a TAN and then pay the tax and file the return. Whereas for resident sellers, it was insufficient if the buyer pays that requisite tax of 1% in a Challan cum return, 26 QB, what was being paid for 194 IA. Now, they have brought about even that for the non-residents under the new 397 1C of the new Act with effect from 1st October 2026. So therefore, till October 2026, they will continue to be governed by the earlier ones. From 1st October 2026, they can file, it is a single challan come return insofar as the buyer is concerned, in so far as the TDS and immovable property is concerned. And in terms of TDS, supply of manpower was a much debated topic, and you had various court judgments on what is manpower being supplied, is it technical personnel, because how 194J was, 194C was, and even in the new section, how work was, what was the definition of work, what was as an used in the 194C of the Act as an explanation, was specifically brought under section 402, subsection 47. Now, for TDS and supply of manpower, it has been specifically covered under the ambit of 393(1) of the Income Tax Act, and they brought about the definition under 402 to say that TDS will be at 1% or 2%, depending on the payee being a individual or otherwise. With effect from 1st April 2026, that's going to be at 1% or 2%, depending on the payee. But supply of manpower has been specifically brought about now for under TDS at 1 or 2%. And in terms of benefits being given to the foreign assets being disclosed under that disclosure scheme, what they have brought about, they're going to give you a 6-month window for the asset disclosure. And you also have two categories of assets in that, being on the value of that asset up to 1 crore. What is the amount of tax you pay? 40% of fair market value, or 30% of the undisclosed income, or 30% of additional income tax, where you have not disclosed the overseas asset and income. In certain cases, you have declared it but only not disclosed. Then you get into a separate category wherein asset value up to 5 crore, by paying a fee of 1 lakh, you can have that disclosure cleared. And very important facet is that the prepayment of tax, though under the indirect tax laws it was mandatory, income tax, it was only directory in nature. It was 20% to be paid by virtue of a circular. Now the prepayment has been reduced to 10% from the earlier 20%. And also they're wanting to integrate the assessment and penalty proceedings. You also have the cotton seeds and other things being brought about the ambit of the cooperative societies. And they're also wanting to have this interest dividend income exemption for cooperative societies if they are for 3 years, if it's going to be further distributed to the members. And specifically now looking at how India is a global hub for technology and the GCCs, and how it's I would say, literally the back office of the world for software development services and IT-enabled services. And you had a lot of controversy about this. What is software development services? What is information technology services? They are now being sought to be clubbed under the IT-enabled services and coming under a common safe harbor rule at 15%. And they've also given the turnover limit being up to from 300 crores to 2,000 crores. They can come into that thing. And this automated rule-driven process will ensure that the safe harbor rules will continue for 5 years. That's a very welcome move, considering that in certain cases the judgments of the courts are not favorable to the taxpayers. So there's no tax certainty is what they believe. If you look at Tiger Global's case, it's a classic case wherein the government will be getting 14,500 crores or 15,000 crores as tax on that case. But what is not being understood is probably the many more thousands of crores of investment which have not come into India because of that. But now that they are also looking at seriously about clubbing this and bringing in a safe harbor 15%, there's definitely a certainty with respect to tax positions for those companies. And you also have the advanced pricing agreements to be done. They have been fast tracked to say that to be completed within 2 years, and at the option of the taxpayer, extendable by 6 more months. And the modified returns concept has been extended for associate enterprises also. These are all welcome moves considering how the industry is looking at insofar as certainty from the government is concerned. The most important thing is tax holiday till 2047 for foreign companies who are in this business of cloud services and data center services. The condition is that it must be owned and operated by an Indian company, and the exemption will start from 26-27 and for subsequent assessment years. The intent is very clear to ensure that India grows as a global hub in terms of the GCCs and how the world is looking up to India in the days to come, because we have been seeing how the data center services and how the foreign companies looking out for tax certainty. Some of them have made representations in the government saying that but the act is very clear that the specified data center must be a data center which is set up in an approved scheme, should be notified with the central government in the Ministry of Electronics and Information Technology, and is owned and operated by an Indian company. So therefore, the objective is very clear: to attract investment in data center and promote artificial intelligence data center framework in India. So in the Schedule 4, they're providing exemption to a foreign company on any income accruing or arising in India or deemed to accrue or arise in India by way of procuring data center services from a specified data center for a period up to tax year ending 2047. Why this is important? We spoke about Amrit Kal from 2020 to 2047 and Viksit Bharat in 2047, which means we'll be self-reliant by then. We would have grown. Definitely, we are on the cusp of becoming the third largest economy, which we will become by 2030 or 31. And by 2047, we will be challenging US and China in terms of the growth and other aspects because of having the demographical advantage, the advantage of having youth who will be an asset to the country in terms of in the upcoming years. Moving on, you also have this for the benefit being given to expanding the scope of immunity from penalty or prosecution. He spoke about how they brought it in the old act for in 270 AA. Similarly, even in the new one, they have brought about in section 440, it was only for underreporting of income and not in the case of underreporting in consequence of a misreporting. So here they are speaking about, you had the 100% there in 270 AA. Here under section 440, because the separate penalty which was existing under 443 for income in the nature of 102 to 106, that is 102 to 106 corresponds to 68 to 69D of the Income Tax Act 1961 and read with 115 BBE. You had that additional penalty of 10% that has also been now subsumed into this to say that. So therefore, existing penalty under 443 is proposed to be omitted and subsumed in cases of misreporting under 439. Therefore, immunity for the same is proposed in 440. However, the taxpayer is required to pay an additional income tax to the extent of 120% of the amount of tax payable on such income in lieu of penalty. In 270 AA, it remains at 100%, but whereas under the new section, it goes up to 120% in terms of immunity from penalty or prosecution. Chairman sir, what is the time I have got to complete this? Lakshmanji?
Maybe you can have another 30 minutes, no problem.
because I would take it up till 6 p.m. Then I have to be live on TV, sir. So therefore,
So then you yourself set a time limit.
Yes.
no, I wanted to know whether I have the time so that the most important ones I will take it up and
Sure. You take up those non-residents or maybe there's a definition of accountant and something like that.
Yes. And insofar as the search is concerned, you had this in the block assessment regime under 296, you had the issue of what is the block period for a third party when only the income related to 1 year was found. You had various issues in terms of whether the it is covered or not. But now they've clarified in 296 to say that if it is pertaining to only one particular year, then the block return, though DHORS, it talks about 6 years and then the unexpired period of block till the last date of the authorizations has been completed. They want the block for the third person. If the income is found only for that year, only for that particular year, you'll have the block assessment going on. And the time limit for block assessments, earlier it was 12 months. Now they're going to extend it to 18 months because they've realized that the information has to be collected from the different wing and then of different parties and coordinated search is happening. So based on that, they're wanting to have it. And in terms of the one important thing which the FM mentioned during the course of her speech was having the concept of corporate mitra in Tier 2 and Tier 3 cities to help compliance for MSMEs, because it will be a coordinated effort with ICI, ICSI, and ICMI to develop the cadre. Probably they're wanting to have people who either completed the intermediate in CA, CS, and ICWA to become this, or probably they're including some tax practitioners under the ambit of corporate mitra so that they will help in facilitating the compliance for MSMEs. And in the TCS, there is important amendment which has taken place. You had the TCS for under the LRS for the education, you had the earlier rate of TCS at 5%. Now it is been reduced to 2%. And for overseas tour package, you had multiple rates and multiple slabs. Now all of that has been brought about in one thing for under the scheme of 2%. And in terms of the STT, it's been raised to 0.05% from 0.002%. And for the futures, from 0.015% to 0.015%. It was earlier from 0.01%. And in terms of the Indian Big Four and rationalization of ICDS and INDAS, they're wanting to have a joint committee with the Ministry of Corporate Affairs and the CBDT working together to ensure that you need not have the separate accounting now. What happens is companies have this INDAS, and for income tax you follow ICDS. They're wanting to rationalize and come out with how uniformly you can look into it. And for the minority shareholders, the amount received as buyback will be taxed as capital gains, whereas the promoters will have to pay additional tax. And from the non-promoters, they will not pay, but only the promoters will pay additional tax. And they have given it in way of a column as to what was earlier 2% and 7% and 10% and 12%, because most of it is now in terms of in columnar form of representations. And the Indian Big Four also is being looked at in a very big way for the government. So the definition of accountant for the safe harbor rules has been brought about for that. So Mathur sir, I think you can continue from here. I will have to definitely log into the media now. If I finish my media engagements quickly, I will again get back to this particular webinar and complete it.
No, I think Prashant ji, you have covered almost everything. The only cause of issue was okay, whether this pre-deposit of 10%, what Radham suggested. Now, is it mandatory pre-deposit 10% for moving to the appeal, or it was just a suggestive thing? No?
Sir, what was mentioned, because even the previous 1961 Act or the 2025 Act, both did not speak about being mandatory in nature. Whereas in the appeal year, the prepayment has been reduced to 10%.
No, it was not under any statute. No?
It was only a circular which was
Circular,
binding
yes.
only on the department, and it was not binding for the assessees.
So now they're specifying the 10%. It seems I've not seen it because the fine print, but
Yes, I'm also trying to look into the fine print, sir. Before the IDT thing is completed, I would answer that.
Sure.
In the meanwhile, I'll finish for 15 minutes. I'll finish the media engagement and get back to this link, sir.
That would be great. That would be great.
Yes, before the IDT proposals are completed, I will try to come back and whatever couple of points are there, I'll try to finish it, sir. The time being, I take leave from this August gathering. Thank you for a very patient hearing. If time permits, I'll come back for further issues to be discussed and for any questions there. For about 15-20 minutes, I'm leaving the meeting now, sir.
Thank you. Okay.
Yes, sir.
Thank you, Prashant ji, for excellent and insightful presentation. And now I request CA Dr. Arpit Haldia, well known for his expertise in indirect tax, to share his insights with us.
Arpit, please unmute yours. Arpit, please unmute.
Thank you, Lakshmanji, and thank you to AIFTP for giving me this platform to discuss the changes which have been made in GST. Although nothing was said by the Honorable Finance Minister in the speech, but the stage was set by the 56th GST Council meeting, wherein the proposed changes were already discussed in the press release, and they have been given now the place in the statute also. And it would be interesting to see that how the relevant amendments take place, because as I was hearing Prashant ji, the fight in income tax amendment is that why the government has made retrospective amendments. But as we see the limited number of amendments which they have made, which are approximately, which I can say are 5 in numbers, out of those two, the taxpayer would be arguing in GST that they should be retrospective because they are clarificatory in nature, and they are seeking to clear the air and the confusion which has been created around those provisions. So it's an interesting situation between IDT and DT, wherein the taxpayer would be arguing differently, and in IDT they would be arguing differently. And this is the beauty of the law, that how you read and understand the provisions, not only what has been written, but what has to be understood through the reading of the provisions. So briefly sharing the presentation on the amendments proposed to the GST Act. The first is amendment to Section 15. And if we go through the previous provision of Section 15(3)(b), for 15(3), Section 15(3), there were two scenarios. One, the discount which is given prior to the supply or at the time of supply, and second is the discount which is given after the supply has been made. So for the discount which was given after the supply has been made, there were two conditions which were attached in, and they were given in Section 15(3)(b). First, that the discount should be established in terms of agreement entered into at or before the time of such supply, and it should be specifically linked to invoices. And second, that the ITC attributable to such discount should have been reversed by the recipient. Now, Section 15(3)(b) has been amended and a new provision has been substituted, wherein it has been provided that after the supply has been affected, if for such discount a credit note has been issued by the supplier and ITC as is attributable to such discount has been reversed by the recipient supply in accordance with the provision of Section 34. So there are three conditions which have now been inserted in 15(3)(b) vis-a-vis the previous conditions, wherein the condition of having a prior agreement that is now been done away with. Second was the condition, that is, it should be specifically linked to relevant invoices. That is also now done away with. Third is that the ITC should have been reversed. Now, this condition remains in the amendment, but along with this condition, two new conditions have been inserted. Second, the two new conditions is that credit note should have been issued. If we see previous provision 15.3b, there was no such requirement of credit note being issued, although in practice credit note was being issued, but it was not coming out specifically that the discount has to be passed by way of issuance of credit note. And secondly, the ITC should be reversed in accordance with the provision of section 34. So now provision of section 34 also finds mention in section 15.3b. What is the impact of this amendment? So the first is, now there is no requirement of having a agreement which is in place before or at the time of supply which has been made, because there were many litigations across the country wherein the department was litigating whether the agreement between the supplier and the recipient was entered prior to the supply, and the onus was being put on the taxpayer to prove that the agreement was executed prior to the date of the supply or before the time of the supply. So there were many litigations across the country. So therefore, by this amended provision, that litigation now would be settled. Second part is the credit note has to be issued and the ITC has to be reversed in accordance with the provision of section 34. My interest is now section 15.3b specifically mentions section 34. Prior to this, there was no mention of section 34 in section 15.3b. And if I go through the corresponding amendment which has been made in section 34.1. So previously in section 34.1, there was no reference to the credit note which was being issued in 15.3b. Now they have amended section 34.1 and they have inserted the reference to where the discount referred to in clause B of subsection 3 of section 15 is given. So now section 34 is also covering the credit note which is issued under section 15.3b. When I read section 15 and section 34 harmoniously, that is the pre-Finance Bill 2026 and post-Finance Bill 2026. Other than the condition of agreement being abolished in section 15 and the reference of section 15 being made in section 34, this is one big interpretation which we can make, that prior to Finance Bill 2026, whatever were the conditions of section 34, that the credit note has to be issued prior to the month of November. It has to be reported in a return prior to the month of November. No such conditions were applicable for the discount and the tax which is sought to be reduced by way of section 15.3b. So for the regime which was prevalent prior to whenever Finance Bill 2026 becomes Finance Act 2026, if anyone has issued a credit note under section 15.3b and the department has issued a notice that it was not issued in accordance and as per the terms and conditions given in section 34, that notice, in my opinion, would not be standing, because section 34 was not having any reference to section 15 prior to Finance Bill 2026, and now it is having a specific reference. So now post Finance Bill 2026 becomes Finance Act and this provision gets into effect. Then only for the credit note which have been issued in 15.3b, all the conditions and the timelines of section 34 would be applicable. So there are two important things which have to be understood when we read section 15 and section 34 on a harmonious reading, and together. No longer a condition of prior agreement is there. Second, post Finance Act 2026 amendment, then only terms and condition and time limit of section 34 would be applicable to credit note being issued under section 15. One interesting read which I can make and which I think would definitely come as and when Section 15(3)(b) amendment takes place. Let's take a scenario wherein I have made a supply of say 1 lakh rupees. I issued an invoice of say 1 lakh rupees. There was no agreement at the time or before making the supply of having or giving a discount. After that, when I have issued an invoice, my recipient only pays me 80,000 rupees. Now, what happens to that 20,000 rupees? In the time which is prevalent as of now, since amendment is not yet made effective of which has been proposed in Finance Bill 2026, department always said that your value of supply would be 1 lakh and you would have to pay tax on 1 lakh. And since there was no pre-existing agreement, therefore no deduction in value would be allowed. But post this amendment, against the invoice of 1 lakh rupees, since I have received 80,000 rupees, even if there is no agreement and before making the supply, and if I and my recipient come to an agreement that yes, the value is only 80,000 rupees, and the recipient says that I only would pay 80,000 rupees, and you have to accept it and issue me a credit of 20,000 rupees. The supplier would now be entitled to issue the credit note of 20,000 rupees, because the only condition which is there now in 15(3)(b) would be that a credit note has to be issued by the supplier and ITC has to attributable to such discount has to be reversed by the recipient in accordance with the provision of Section 34. So as a supplier, if I issue a credit note and my recipient accepts it in IMS, then it would be treated that he has reversed the ITC, and since he has reversed the ITC, I would be entitled to reduce my liability. So somewhere down the line, this amendment would be opening a new point of litigation, that whether by way of this amendment, can supplier and recipient come to a post-supply agreement that whatever has been paid is the actual value of supply, irrespective of the fact that whatever was raised by way of invoice. Now, the second amendment which have been made in Section 54. So the first amendment is Section 54, subsection 6, wherein amendment has been made for giving provisional refund in case of unutilized ITC, or what we say that is inverted duty structure refund. Although instruction number 6/2025 dated 3rd October 2025 was issued in pursuance of the recommendations made in 56 GST Council meeting, and amendment was made in Rule 91 sub-Rule 2. Now the corresponding provision in Section 54 subsection 6 has also been inserted, wherein now provisional refund as per statute, although as per government they have been brought in place and the field formations are acting according to it, by way of instruction issued on 3rd of October 2025 and amendment made in Rule 91 sub-Rule 2. Now the amendment has also been made to the amendment is also proposed to be made into the CGST statute. The next amendment in Section 54 subsection 14. Section 54 subsection 14 provided a limit that if the amount is less than 1,000 rupees, no refund under subsection 5 or subsection 6 of Section 54 shall be paid. Now an exception has been created that this restriction of 1,000 rupees would not be applicable in cases where refund of tax is claimed on account of goods exported out of India with payment of tax. That is, wherein small consignments are being exported by way of courier and against payment of tax, and the amount of refund involved is less than 1,000 rupees. So this is now an enabling provision in Section 54 subsection 14, that if small consignment of exports are being made and the refund amount is less than 1,000 rupees against payment of tax, then also the refund would be granted, and restriction in Section 54 subsection 14 would no longer be applicable. Again, the stage was set by the 56 GST Council meeting. The recommendations were made, but now the enabling provision in the statute is sought to be inserted. Another amendment is insertion of section 101 capital A, subsection 1A. Section 101 capital A provides for setting up of National Appellate Authority for advance ruling, wherein there is a dispute between the members of the advance ruling authority on a certain position. There is a split verdict. So as per section 101B, there were certain conditions wherein the matter would be referred to the National Appellate Authority. And then the National Appellate Authority would decide that what is the decision on the particular matter which has been referred by, on which there was a dispute between the members and there was a split verdict between the members. So now interestingly, for 101A, subsection 1A has now sought to be inserted. And it says that notwithstanding anything contained in subsection 1, till the National Appellate Authority is constituted under the subsection, the government may, on the recommendation of the council, by notification, empower any existing authority constituted under any law for the time being in force to hear appeals made under section 101B. Now, an existing authority is sought to be empowered to hear the appeals made under section 101B, wherein one of the situation is a split verdict between the members of the advance ruling authority. Now, who can be the existing authority? That explanation has been inserted that for the purposes of this subsection, the expression existing authority shall include a tribunal. That means an indication is sought to be given that the tribunal which has been constituted, that is the principal bench, might be given the role to play for the National Appellate Authority in case of advance ruling. And this would again be an interesting scenario because now the tribunal which has to hear the matters which are arising out of the orders of the adjudicating authority would now be deciding the matters which are not which have not arisen due to the order passed by being at the adjudicating authority and appellate authority, but the taxpayer is seeking an advance ruling on that matter. And when we speak about advance ruling, it is commonly understood that it is an arrangement between a taxpayer and the department, wherein the department would be giving its view that this is our view. And if the assessee accepts it, it becomes binding upon both. If the assessee does not accept it, he has to file an appeal. And until he files an appeal, it is a binding precedent on the taxpayer also. But now, if the tribunal would be authorized to hear the matters in case of an advance ruling, in my opinion, that would be going beyond the concept of an advance ruling, wherein the appellate authority, the last fact-finding authority in the statute, would also be sitting and judging the matters of advance ruling, which ideally should be decided between the taxpayer and the department. So there are some fill in the gaps which are sought to be made by way of this section 101 capital A. And in my opinion, it is going beyond the concept of the advance ruling which is there. Now, the last amendment which is proposed under section 13 of IGST Act, that is place of supply in case of intermediary. Again, the stage was set by the 56 GST Council meeting, wherein the council recommended that the place of supply in case of an intermediary, which is the location of the supplier, should not be so. It should be ideally the location of the recipient, so that the concept of intermediary is still there, but then in such cases, the place of supply would be the location of the recipient, and the supplier would then be entitled to treat his supply as an export of service provided he satisfies the other conditions of place of supply, it would be outside India, location of recipient would be outside India, and the amount being received in foreign currency. So this was a ongoing litigation between the taxpayers and the administration which has reached to various high courts that what should be the place of supply in case of intermediary. Honorable Bombay High Court has given its judgment in Dharmendra M. Jani. First, there was a split verdict, then there was a larger bench decision, and then the matter is pending before the Supreme Court. And secondly, there are many other decisions of the High Court wherein it has been held that for intermediary services, the place of supply should ideally be the location of the recipient. So now this amendment has been proposed in IGST Act. And as I said, that now in GST, the taxpayers would be arguing that the amendment which have been proposed in 15.3b and section 38, that is, there should be for 15.3b there should be no requirement of an agreement, and section 38 which which provide that the place of supply should be the location of the recipient. They should be retrospective amendment. From where they would be getting the support? See, the first decision, it is coming in case of Commission of Delhi GST versus Global Opportunities Private Limited, 2025 decision and 179 Taxman 305, wherein Honorable Delhi High Court, while discussing about the place of supply in case of an intermediary, referred to the discussion made in the 56 GST Council meeting and the recommendation made. And it was specifically observed by them that thus intermediary services are no longer services for which the place of location of the supplier would be deemed as place of supply. Even for such services, the place of the recipient of the services would be the place of supply as per section 13(2) of IGST Act. The confusion, what they have said, that this was a confusion that was prevalent relating to the intermediaries and their entitlement to claim benefits on the basis of exports of services is eliminated. So how Honorable Delhi High Court interpreted the amendment, that the amendment which is proposed now, which has come in Finance Bill 2026 and which will subsequently be notified by way of Finance Act 2026, is to eliminate the confusion with regard to the intermediary services. Now, one thing is clear when we go through this decision, that there was a confusion, and by way of this amendment, the confusion is sought to be eliminated. Another decision by Honorable Calcutta High Court in case of iProcess Clinical Marketing Private Limited versus Assistant Commissioner of Commercial Taxes. This was also again relating to place of supply. Although not relating to intermediary services, but relating to the research and development services which were being carried out in relation to drugs and pharmaceuticals, wherein certain goods used to come to India and the research and development services used to take upon them. And then the question was, what was the place of supply? So now bare reading of section 13, subsection 3, place of supply was the place wherein the activity relating to research and development was being carried out, because there was a requirement that the good should be placed while the research and development activity is being carried out. Thereafter, a notification was issued specifically for the pharma sector by way of 37th GST Council meeting on dated 30th of September 2019, wherein they provided certain categories and said that for these categories, the place of supply would be the location of the recipient, not where the supplier is located or not where the activity is being carried out. Now, the question was that the notification was issued on 30th of September 2019, whether it would be having a retrospective effect or a prospective effect. The department said that this notification would be having a prospective effect. The taxpayer argued that this would be having a retrospective effect. Honorable Karnataka High Court said that it is a well settled position that all amendments which are beneficial in nature, which are elucidatory and clarificatory, would operate retrospectively when they seek to clarify and elucidate certain existing facts and situations, and consequently having regard to the specific observations made in 37 GST Council meeting, whereby it was resolved to clarify the tax liability in relation to foreign recipients of R&D services provided by Indian pharmaceutical companies. The impugned notification at Annexure G, dated 30th of September 2019, is clearly retrospective, being clarificatory and elucidatory in nature, and consequently both the respondent clearly fell in error in coming to the conclusion that the said notification is prospective. So applying the same principle which has been given in iProcess clinical marketing and going through the observation made in case of Global Opportunities Private Limited, taxpayers would argue post this amendment that although finance bill provides it as a prospective amendment, but since it's a beneficial amendment, seeks to clear confusion, and already there is a decision of one of the high courts wherein they have said, one of the high courts, that is Bombay High Court in case of Dharmendra Ramjani, wherein this issue has already been decided in favor of taxpayer, that this amendment should be retrospective in nature. And similarly for 15(3)(b) also, that the intent is that the tax should be received on whatever value has been received by the supplier. And whether or not agreement is there, since in both the situations, tax has been duly received by the revenue to the extent what they have received. Therefore, the condition of agreement not being there in place prior to the date of supply is only a procedural condition. Therefore, this amendment in 15(3)(b) should also be treated as a retrospective amendment. I would not say that this would be the law, but this is how the things might take shape post this amendment comes into picture. Two another interesting observations. This amendment of intermediary has been brought in by clause 141 of the Finance Bill 2026. When we read through Finance Bill 2026, it says save as otherwise provided in this Act. Section 2 to Section 113, Clause B of Section 136 and Section 140 shall come into force from 1st day of April 2026. Clause C and D of Section 136 and Section 142 shall come into force from 1st of May 2026. Sections 137 to 139 shall come into force on such date as the central government may by notification in official gazette appoint. So if we read through A, B and C, there is no mention of Section 141 or Clause 141 of Finance Bill 2026. That is amendment relating to intermediaries when it will come into force. It might have skipped. They might amend Finance Bill 2026, but as of now, there is no mention of Section 141 in Finance Bill 2026, that from which date it would be made effective. Another interesting observation which is there in memorandum explaining the provision of Finance Bill 2026, when they explain the amendments which have been proposed in GST, it says unless otherwise specified, amendments carried through the Finance Bill 2026 will come into effect from the date when the same will be notified concurrently, as far as possible, with the corresponding amendment to the similar acts passed by the states and union territories with legislature. So what they have tried to say, that we will try as far as possible to notify it concurrently along with the states when they have passed similar acts for amending their respective state GST acts. So the interesting word which I have used is as far as possible. So now, when we read this, can we infer that the government is trying to say that we will wait for the state governments to make corresponding amendments as far as possible, but even if they do not bring it, we will do it on our own in CGST Act, even if the states have not done it. So this use of as far as possible, and if we link it to the intent, then it would be an interesting scenario wherein the amendment in CGST Acts have been made because the center waited for the corresponding amendment in State GST Act, but the State GST Act was not concurrently amended. So the Central GST Act was amended. Now, an officer issues an order for the provision which was amended for CGST Act, but a provision which was not concurrently amended for SGST Act and which was amended later on. I would not say that they were never amended, but it was amended later on. What would be the position of legality of such notice? Because what this memorandum is trying to say is something which could reshape the entire legislation, wherein the center would be making the amendment, waiting state to make the amendment, but since the state has not made it, center would go in on its own and make the amendment. Because until now, what we have seen is that the center has waited for the amendments. Yes, there are certain examples wherein states have not amended, but the center is amended. But now it has come in writing by way of memorandum explaining the provision of Finance Bill 2026, and it would be an interesting scenario that how the things shape out for the legality of such provisions. Because CGST has made the amendment, but state GST has not made the amendment. So whether the corresponding demand or the process being carried out under state GST would be valid or not. So this is something for the future we have to see. And with this, I would like to conclude the presentation on the GST, although there was a limited amendments which have been made, but the impact, because whatever we read in a press release and whatever comes in the final printout has a completely different understanding. So I've tried to summarize it in the best way possible. And as I've discussed that there would be host of litigations coming on, although there are limited number of amendments, and there are huge opportunities to interpret and how it has to be understood. Thank you very much, AIFTP, for giving me this opportunity. Handing over the session back to the organizers.
Thank you very much, sir, for your excellent and valuable insight on indirect taxes. Due to an urgent engagement, our session chairman Pankaj Ghiya ji will not able to continue further. Before we move to the vote of thanks, I now request Sri Anil Mathur ji to kindly conclude the proceeding of the session.
Thank you, Zone Chairman. Are you sure Mr. Prashant is not coming back?
Sir, time lagega humko.
Okay. I think yes, the most of the amendments have been covered up by Mr. Prashant very well, and it has been very educating session, understanding by the nuances of budget on the day one. I think, and we are grateful to both the speakers, Mr. Prashant and Dr. Haldia from Jodhpur, who has very nicely dealt with this indirect tax proposals. And now I request Mr. Bhaskar, if he want to share his views on the direct taxes. Bhaskar,
No, sir, somebody is raising a hand, sir, Mr. Gunnala Srinivasa Rao. I don't know whether it is direct taxes or indirect taxes. If it is direct taxes, you can take it. Gunnala Srinivasa Rao.
I think there is a query also, what will be the excise on units engaged in tobacco leaves, only drying and breaking into small pieces? Mr. Haldia, if you can.
I am not dealing in excise, so I would not be able to take it.
Okay. Sorry, Mr. Awala. Unfortunately, neither me nor the panelists deal with the excise, so we are unable to provide the answer to the query. And somebody has raised hands. If he's there, then we request him to kindly unmute himself and.
Gunnawala ji, please unmute yourself.
One Mr. Singla Party has raised a question. Please clarify the fate of cases at different stages where the SC got relief from the High Court or ITAT where the department has filed SLP against the High Court judgment. For information, possibly he is asking about the FAO job issue and the other issue, limitation issue. FAW issue is listed before the Honorable Supreme Court on 16th or 17th of February. Possibly they will be taking another date for the act to be, the bill to become a law. And the fate of it will be all those cases will have to be remanded back to the High Court or the tribunal for a decision on the other issues, if there is any. Yeah. Sir, the one Mr. Abhishek Gupta has asked for the PPTs to be circulated. We'll try to circulate it in the group, sir.
Okay, sir.
Yeah.
Now, sir, conclude करें.
If there are no more queries, because whatever the limited amendments that have been left was, so there would be, Bhaskar sir, I think there would be some issues clubbing assessment procedures with the penalty proceedings.
Yes, yes.
I think you will have a more demand.
That is why, sir, 20% has now been reduced to 10%.
So,
but only saving grace is that till the CET appeals decides, the interest will not start running.
But so far income tax was concerned, the pre-deposit wasn't a mandatory condition, but now it seems.
No, sir. Now I have checked out the provisions, sir. Okay. Even now, it is only when they go for a stay, 10%, that too 10% of the tax portion alone. Earlier it was 20% of the total demand. Now it is 10% of the tax portion alone need to be paid as per the circular. Of course, the circular carries some exceptions. So I think all those exceptions will continue to operate. Yes, sir.
So what the Honorable Finance Minister wanted, I mean, we had a good fiscal deficit under control. We had reasonable growth, GDP growth. In spite of that, ease of doing business, we ranked 63 in the World Bank ratings. I think that she has tried some announcement through this budget also, so far as to help out the ease of doing business. What she has stated that the rules and forms will be shortly provided as early as possible. And for the small taxpayers, what has been proposed that you can now have a nil deduction or lower deduction online only. I mean, you need not to apply for that. 15G and 15H have been to the depositories can also be issued. And for tax audit report non-filing, the penalty has been now shifted to a fee. So there would be a fee rather than a word penalty, and what is the amount that is not specified. And the decriminalization of non-production of books and TDS provisions has also been introduced. One thing was that intercorporate dividend on the case of a cooperative societies that has been given exemption, provided it is distributed amongst the members itself. Safe harbor rules, Bhargav, would be an issue because with the integration of every services into IT services, because the margin in all the services are not same, and 15% of the safe harbor rules may create some problems. And I think possibly for that reason, all the institutes or the government wants that everyone should come together for this. ICDS provisions have been given a go by 1/4/2027, and that's why the accountant definition has been changed. I think now all the institute members would be considered to be an accountant as far as safe harbor rules are concerned. So safe harbor rules are definitely there, and a lot of incentive have been given to non-residents to start a business, an exemption for that. Maybe looking to the Trump factor or something like that. But yes, they are there. They are welcome. But looking to the non-residents tendency, they are not going to jump into the Indian business very shortly unless ease of doing business is improved. So I think what Mr. Prashant was also telling about this the tier 2 and 3 benefits. Even Comptroller and Auditor General of India office has issued a notification that if a chartered accountant wants to work in these cities on a fixed salary basis, I think that advertisement is there. So they are all looking to the globalization of Indian audit firms also. So in that context, I think these are some welcome steps. And with this, we come to the end of this particular session. Thank you very much, Zone Chairman, for initiating on the day one. And thanks a lot to both the speakers and session chairman for very ably, nicely conducting the session. And thank you, Bhaskar sir, for being here on our request. And so to the Deputy President, who, in spite of being on his personal visit to a remote place, Allahabad. He also joined. Over to you, Lakshman.
Thank you, sir. On behalf of AIFTP Central.
Prashant ji has again joined.
Yes. I just finished debate, so I thought I just heard last line of Mathur sir speaking about global Big Four and other things. And Mathur sir also checked with the in the finance bill. There is no reference to the mandatory thing of 10%. It continues to be governed by the circular only. It was only in the speech that she has brought out, which means a circular. Unless they choose to specifically amend the Income Tax Act 2026 before again it
Don't
because
give
it's
ideas,
not started.
Prashant.
Already we've had amendments in that. Unless they decide to amend it after the bill, before the act once again, it remains directory in nature. And Bhaskar sir, I'm able to see you in Eastman color, not in the regular color.
Yeah.
Bhaskar sir is in Eastman color.
Yes.
Now, if any further queries are there, I can take it.
He is using Polaroid, I think, screen.
So, Mathur sir, did any other questions come up in terms of?
No, there was a question on customs which I think none of us was able to answer it. The rest we have taken care of.
Okay.
So thank you very much, Prashant sir. It was a pleasure having you on this Central Zone's first day webinar. So, I had an honor and privilege to share the proceedings with you earlier also, but due to this my medical exigency, thank you for sharing the entire burden and yourself. And I think kudos to you for very nicely dealing with a lot of amendments that have been made out. Thank you very much, Prashant sir.
Thank you, sir. Thank you, sir.
Thank you, Mathur sir, Prashant ji. On behalf of AIFT Central Zone, I sincerely thank our session chairman Pankaj Ghiya ji, Anil Mathur ji, and our learned speaker CA Prashant GS from Bengaluru and CA Dr. Arpit Haldia ji from Jodhpur for their valuable insights on the Union Budget to 2026. I also thank our respected National Secretary General Bhaskar ji, Sandeep Agrawal ji, esteemed office bearer, and all members for their gracious presence and active participation. With this, I once again thank you everyone and wish you all a pleasant evening. Thank you all. Namaste.
Thank you.
Thank you.
Thank you.
Bye-bye.